guys, and welcome back to the Matt to Million channel, and in today's clip we're going to be taking a look at, do you pay tax on Forex, and if so, how much do you pay? Now, whether you're thinking of starting Forex or whether you've just started, or even if you've been trading for a while and just buried your head in the sand when it came down to tax, I'm hoping to put this video across to provide you some value and context as to what you can expect when trading on your personal account in terms of tax liabilities. Now, my videos are of course only for entertainment purposes only. I'm not a chartered accountant, so for any final financial decisions, always make sure that you consult with a finance professional, be that an accountant, tax advisor, the HMRC, or whoever. In this video, I'm going to present my own opinions and my own personal experience with tax and with Forex, and hopefully give you a bit more of an understanding and some value to take away before you go off and try and find your own accountant. So, as always, if you are enjoying my content, please just hit that thumbs up button, subscribe to the channel if you haven't already, and make sure you click on the alert so you'll be alerted to when I'm posting my next video. Cool, so let's get to it. Tax. Now, obviously, I'm going to be speaking, as you can tell from my accent, from a UK perspective. Now, I'm sure there are some similarities internationally, but I just want to reiterate that just before we get going. And in this video, we're going to be focusing on your own personal tax liabilities when you are trading your own personal account as an individual. Now, there will be another video following in a few days about if you are setting up a limited company to trade your own personal account. But if you're viewing this in the future, I'll link it up here. Now, as said, this is a video that's been requested, and this is based on your own personal Forex trading account or day trading account, whatever you want to call it. I do have two other videos that specialise purely on FTMO tax. One of them is the FTMO tax as an individual, which I'll link up here. And I have got another video for FTMO traders. If you're looking to set up your limited company, what sort of liabilities you can expect on that. So for the FTMO limited company tax setup, I'll link that one up here. So for this one, focusing on the personal taxation on your personal Forex trading account, and let's kick it off. So the big question, do you pay tax on Forex trading from your personal Forex trading account? And the answer is, it depends. Now, the taxation around personal Forex trading accounts and day trading accounts is very, very grey in the UK legislation. And in this video, I'm going to try and give you a bit more detail into why that is, and hopefully give you some more context as to what you should be considering. But as a general rule, it's pretty safe to assume if you are pretty good at Forex trading, then yes, you will have to pay tax of some description. But if you are below average, then the story might be a bit different. Now, there are three key ways to trade, if you like, in the UK. Now, there's a normal stockbroker option, which is where you could buy a share or whatever. The second is CFDs, or contracts for difference, where you buy contracts for an underlying asset value. And the third option is spread betting in the UK, which is where you don't own anything and you are essentially betting. Now, for the stockbroker option, this is pretty common for most people in the UK, and it's been around for decades, and this model of going in, buying a share, or doing it online, or back in the day doing it on the high street. For the other two, I did do a separate video, which I can link up here, but it isn't as in-depth as I would have liked. It was one of my early videos. So in this video, I'm going to give you a summary of CFDs and spread bets, just to give you some key points about both, so as you can consider what you're doing from a tax perspective. Now, spread betting is probably the rarer of the two in the UK, and there are some limited brokerages that do offer a spread betting service. Now, spread betting is where you put down in your own currency a certain amount per movement up or down on a certain indice, on a certain FX pair or a cryptocurrency or whatever you like. Now, spread betting from a tax perspective is actually classed as gambling. This is mainly because you don't own any particular asset or a contract to a particular asset that can go up or down. You literally are just betting on the direction of a movement of any particular pair or indice or whatever. So in the eyes of the law, it's not technically seen any differently to going down to your local casino and putting down a bunch of money on a single number on a roulette wheel, or even going down to your bookies and putting on Chelsea to win, if that'd be a good idea. But the key thing here is that the tax liability could change depending on your own personal circumstances over time. And with CFDs, you are eligible for capital gains tax, and the main reason for this is because you own a contract for an underlying asset that can move up or down in value. So actually you do own something, and therefore it will appreciate or depreciate in value, and therefore it will fall within the capital gains thresholds or the scheme under the HMRC. And hence CFD being contracts for difference, because you own a contract of certain value that could appreciate or depreciate in value. And as for the amount of capital gains tax you pay, this will be dependent on what tax threshold you're currently sat in terms of your overall earnings outside of your CFDs. But you do get a £12,300 allowance for capital gains tax, so that is completely tax exempt. And then if you do fall into the basic rate taxpayer division, you'll pay 10% on any profits within that threshold. And if it breaks into the higher rate tax rate and above, then you'll have to pay 20% on capital gains tax on any of your profits beyond that point. Capital gains tax does technically fall into chargeable assets and property. Of course, this isn't property. So if you're a pretty good trader and it is your sole income, then the simplest and least grey way of managing your affairs is to run it through a limited company. Now, as described, I have done a separate video on this that is coming in the next few days, but if you're watching this past the next few days, then I'm going to link that video here, and we'll go fully into the limited company approach and how it simplifies everything for you. But given that the average retail trader isn't looking to set up their own company and start running profits through there and getting accountants to do the corporate tax return and the VAT returns and making sure you're updating company's house and all the rest of it, that's why we're focusing on the personal taxation of a personal trading account. Now, to give you a bit of background, the tax that you qualify for really does depend on your personal circumstances is how well you're trading and also what you're trading with. Now, though you may immediately think the government will always want to tax you immediately on your trading profits, this isn't necessarily the case, and now I'm going to try and explain why. Now, this is why it's such a grey area, is that in order for the government to say that they're going to tax you income tax on your trading profits, they have to give you what's called trader status. The issue with the trader status is that this opens it up to be part of your self-employed income. So that means that any losses that you get from your personal forex trading income or day trading income, you can offset against any other forms of income tax because it's seen as a form of income. So to put this into perspective, let's say you're working another job or you're self-employed doing another job or you've got another stream of income from a limited company, let's say. Now, what this means is that when you have trader status, if you make any losses on your trading account, you can offset them against any income tax that you pay. Let's say you're working in a UK company that's paying you £50,000 per annum. Now, on that £50,000, you pay £7,500 in income tax alone, which of course the government always get. Now, if you were to be given trader status on your personal trading account, then what this means is that you'd be able to offset any losses against that income tax that you're earning in your other job. Now, to thicken the plot even more, it's a well-regarded fact that 80% of retail traders actually lose money. Now, from the government perspective, if that retail trader, or in that 80%, the people that are losing money, do actually have another job, the government are then getting all of their income tax from their other job. Now, when a retail trader loses money with IG Markets or CMC or whoever you want to talk about, that is obviously a profit for that institution. So the government also get the corporation tax that they would charge on those profits. So it's kind of a win-win for the government. 80% of traders fail, so they put the money into the brokerage. The brokerage then declare that as profit and they have to pay their corporation tax on that profit. All the while, whilst you're in your normal job, you're paying income tax to the government, so they get your income tax and they also get the corporation tax from where you've lost your money with the broker. Make sense? Now, of course, from that, there are even more benefits for the government because if a corporation earns more money and more people lose money, this means that maybe the broker can employ more staff or they can expand offices or whatever, but all of these things will incur taxes that the government will capitalise on or employer contributions and all the rest of it. But ultimately, the government really does capitalise when you lose money in this situation. So, if the government were to give every single retail trader, and there's nearly 300,000 of them at the moment, all trader status, and the 80% of them lose, they can claim back those losses on all of the income tax they paid in their normal job, and the government will be out of pocket. And let's be honest, even with the 20% that don't lose money, that doesn't mean that they're earning a huge amount of money. This could be breaking even or just being partially in profit by a few quid. So even if they decided to give all the 20% of the successful or not losing retail traders trader status, the problem is that if they're only earning a marginal amount each year, the government aren't really going to make anything on the income tax, or it's going to be very marginal in comparison to what they could lose. So if somebody had a really great year for them, which could have been just above break even or a few thousand in profit, if they open the next year, once having trader status, and absolutely bomb it and lose like 10 grand, they can claim that back from their normal job from the income tax that they've paid. So it's essentially free losses. And obviously from a government perspective, is it really worth that risk of giving someone trader status to try and scrounge an extra sort of 2, 3, 10 grand or whatever, when they actually are opening themselves up to a very risky industry where a lot of people do just lose their mind and lose a load of money? That could wipe out 300,000 sets of income tax that the government rely on to keep the country moving. So hopefully that little nugget has given you some concept as to why the government may not be as willing as you may think to try and tax you on every single trading profit that you make, because they've got to think of the bigger picture and also what they're exposing themselves to. So, what does this mean for you and how do they define whether you're taxable or not? In order to assess, they tend to start with breaking it down into 3 simple categories: speculative, self-employed and private investor. Now, speculative, the easiest way to explain it is essentially gambling, where there's no real rhyme or reason as to what trades you take. It's very sporadic. Sometimes you can make a lot of money, sometimes you may not. It's very ad hoc and you can't really find any patterns in terms of how you're trading. Self-employed is where they give you a status where they feel that it's a profession and they're actually classing that as your main income or an income, so therefore you are liable for business tax or normal self-employed tax as you would be for any other job that you could be working at the time. And a private investor is seen as somebody that buys assets that they are looking to develop income from. So that can be interest payments or dividends, all that sort of stuff. Now, speculative, as we said, is really just the average Joe that might go on there, open an account, put a few £100 in it, click buy, click sell, either make some money, lose some money, end up blowing the account, not seeing for about 4 months. He comes back on thinking he's got the secret sauce. Yeah, I'm going to burn it this time. Does the same thing, 3 or 4 random trades, no rhyme, no reason, and loses money. That's really speculative, and that's why you can understand how it's very, very difficult to be seen in this category. Now, the key difference between self-employed or private investor is really that a trader status or a day trader, i.e. the self-employed one, is really viewed as somebody that is looking to make frequent profit, similar to how a shop would, buy inventory and try and sell it for a profit. A private investor is seen as more somebody who actually buys an asset to keep it long term and may earn money from the core asset, but is unlikely to sell the asset within close proximity to make money on the asset itself. So, in short, the private investor falls into the capital gains tax threshold, the self-employed status or trader status falls into your income tax threshold, and they're the key differences between the two. Thought that was the end of it? Of course not. Now, of course, when you're first starting out, you can come up with your own sort of grading and understand with all of this information, all the grey areas, how you would deem yourself and how much tax you would declare and how much you would pay. But once you start earning some serious cash, that's when the HMRC, should they want to, can audit you and look into all of your files from the past 6 years, and then they can come up with their own determination. Now, the sorts of things that they're going to look for in terms of their determination of what sort of trader you are and what sort of tax liability you look for, they're going to be looking at these key things. One is motivation. Within motivation, they'll look like, was it a one-off trade where you've made all this profit, or was there consistent trades that could be likened to a professional, that sort of thing? Is this your sole income, / would it be classed as your trade, / would you be using trading as your living? And also the sort of thing they'll be looking at is how you use your profits, or what you do with them once you get them. Do you just withdraw them all and go down to Selfridges and Harrods and have a spend up, or do you reinvest them to try and make more money in the same vein? Now next, they'll consider the transactions themselves. So one would be, how did you acquire the shares or options or whatever you're trading at the time in the first place? Now, if you bought them, that's obviously going to be a different situation than if you inherited them, for example. They'll look at the timing in terms of how long each position was open for, or on average. They'll probably take a look at whether you used leverage or credit or whatever as how to get into the position in the first place, and also what caused you to realise the position. You know, for example, if it was in an emergency or where you had to liquidate all your assets because there was a family emergency or something, then that won't really be seen as sort of a deliberate trading profit as such. It could be that you're just trying to relieve equity to try and pay for emergency treatment, for example, as opposed to a professional attempt to liquidate assets in a profitable way. And the last key thing they're probably going to look for is the frequency of trades as well. So are you trading 5 times a day, 5 times a week, 10 times a year, whatever it may be? And also the trading behaviours within that. Are you trading the same thing over and over again? Like, could it be the FTSE? Could it be a specific pair like pound dollar or whatever? You know, is there consistencies? Is there trading behaviours? And would they be able to see that from your trading history? Now, all in all of this information is to be taken into consideration, yes, but it also should be pitched against all that information that I said earlier in the video as well, as to how willing the government and how forthcoming they're going to be in terms of giving someone trader status, and will it pay off for the country is really what's at the forefront of their mind. Okay, so to give a summary of my thoughts on all of this so far. So spreadbetting is classed technically as gambling under UK tax law, and I'll say that it's fairly safe to assume that if you were spreadbetting alongside your normal job, you would have to really supersede how much you're earning at your normal job by quite a way before they start looking at it for income tax, because the only option you've got with spreadbetting is either income tax / self-employed / trader status, or tax-free. So there's no middle ground, and they need to be really damn sure that you're making consistent money and good money, and enough money that would give them a bigger increase in tax to warrant them taking the risk of giving you that trader status. You've got to think of it from the government's perspective. If you're earning £50,000 in a job and you're earning £50,000 spread betting, the additional tax revenue is substantial, but at the same time you could just make a massive loss the next year and wipe out all of the guaranteed income tax that they could have got from you. So it's a big consideration, and that's why I say that usually you'd have to really look at, I don't know what the figure is, but you'd have to be superseding your normal salary by quite a bit for them to see that as a sole income that you're relying on for a living. Now, of course, the other point is if it is your sole income and if all you're doing is spread betting. Now, technically, yes, that would fall into trader status or self-employment. But again, in order for the HMRC to declare yourself as trader status, they want some assurances in terms of how well you've traded, you know, how much you're making and on what consistency. You know, if you've only been trading for 8 months and you made 50k, yes, they could tax you on that, but once they give you that status, you could then offset that against that if you then blew your account over the following couple of months and then you got a normal job. You could claim all of that tax back over the following year when you're working in your normal job. So yes, technically things do fall quite obviously into certain categories, but really when you're thinking about it from their perspective and also what you can use in an argument, you know, in terms of the grey areas, then really, you know, you need to consider what they're thinking, not just what it could be. But as I said earlier, just to reiterate, with spread betting, your only two options really are going to be tax-free or self-employed, and you're going to be eligible for income tax and also the national insurance contributions, because they're going to give you trader status and it's going to be seen as your profession. So it really is one extreme or the other. Just to give you the info, just in case you're not up to scratch at the moment, but the income tax thresholds in the UK are currently, you get a personal allowance of £12,500 where you pay 0% tax. Then between £12,500 up to £50,000 you pay basic rate tax at 20%. Between £50,000 to £150,000 you pay higher rate tax at 40%, and then above £150,000 you pay additional rate tax at 45%. But But just as a heads up, once you start earning over that £100,000, you do start losing your personal allowance. So for every £2 that you earn above £100,000 up to £125,000, you lose £1 of your personal allowance. So essentially between 100k and 125k, you're taxed additionally because you lose your personal allowance. And just to reiterate, your NI or national insurance contributions are split between class 2 and class 4. If you're making a decent amount of money, you're likely to be falling into both of these. If your self-employed profit is around 6,500 plus, then you'll fall into class 2, and this is a flat fee that you'll pay weekly for the entire year. So that's £3.05, that works out to about £158.60 over the course of the entire year. Now if your profits exceed £9,500, then you qualify for class 4 national insurance. Class 4 has you paying 9% on anything between 9.5k up to 50k, and then 2% on anything that exceeds the 50k mark. So just bear this in mind, because this is an additional expense once you do get that status. So that's what you can expect on your spread betting options. Now CFDs, or contracts for difference, as we said before, are eligible for capital gains tax because you do own a contract for the underlying asset. As you'll be making an appreciation or depreciation on technically owning an asset, then that is why it falls into capital gains tax. Now this can trade if your CFD trading activity is deemed too day tradey and not so much on the personal investment and growth side. I mean, this can be down to frequency of trades, types of trades, the length of hold, all that sort of stuff. But then again, you do have to bear in mind that capital gains tax is owed as standard. So the government is pretty much guaranteed your capital gains tax on your profits, and that can be anywhere up to 20% depending on which tax threshold you fall into. Now it is a real big decision, especially in this case for the government, to take you from what's deemed as capital gains tax to then moving you into a trader status and being seen as self-employed and moving you into income tax and national insurance. Because although they could earn more money from charging you income tax on your profits, it does also mean that you can offset your losses again with your CFDs against your other income tax liabilities as well. So if you're in the higher rate band, they are essentially risking 20% guaranteed capital gains tax to come in the hope that they could switch you to income tax and switch that to 40% in terms of what they could gain. But by doing this, they are opening themselves up for, if you did have a bad year, you could claim your CFD losses against all your other income tax responsibilities and they could end up with nothing. So it really comes down to whether they're willing to risk 20% to get 40%, but in the process they could end up with nothing. And in most cases, this is a very, very difficult decision, and this is why they aren't just frilly-nilly giving away that trader status. So overall, CFDs would stay within the capital gains tax initiative unless you are a really exceptional trader. So just to reiterate, the capital gains tax policy is that you do get $12,300 as a free allowance where you aren't taxed on any of those profits, and then anything above that will depend on what threshold you fall into from all of your earnings. So if you're a basic rate taxpayer and you've got gap left in your basic rate tax, you'll pay 10% capital gains tax on anything that falls within basic rate, and then anything in higher rate, you will pay 20% in capital gains tax on that amount. Maybe giving you an example is a bit easier and a bit quicker. So let's say you're earning 30k in your normal job and you earn 30k from your CFD profits. You'd have £12,300 of that £30,000 profit tax free. You add that to your total earnings, which is the 30k from your other job, which means that you would have earned £42,300. And this of course means that you've got £7,700 left in the basic rate tax threshold, which is up to 50k in earnings. So with that £7,700, because it's in the basic rate, that means your capital gains tax on that amount will be 10% and therefore £770. And the remaining £10,000 will be subject to the higher rate capital gains tax, which is 20%, so that brings that to £2,000. So overall, your capital gains tax for your £30,000 in profits on your CFD account comes to about £2,770, meaning of your CFD profits, you'll take home £27,330. So all in all, there's a hell of a lot to consider for when you start making good money, if you're going to remain as an individual, if you're going to turn to the limited company approach, because of all the grey areas that we've covered in this video, and this really is just scratching the surface. Of course, the advantages of so many grey areas is that if you do have merit to your stance, then it is unlikely to be overturned in terms of being backdated, but that's not to say that it wouldn't be deemed differently from that point moving forward. And of course, needless to say, the disadvantage of grey areas is you just never know fully where you stand. All in all, as a safety blanket, I'd always store at least 20% of your profits in a bank account aside. Even if you think you don't owe tax, just put 20% aside and just see. Because if you do get an unexpected call, or if you do get a determination that you weren't expecting, you could be liable for a bill, and very quickly. And if you're spending all of your money, you will really, really be in a tricky situation and very difficult to get out of. As a rule of thumb, as a bare minimum, I would still put 20% aside in a tax account to make sure that you're covered in that eventuality. But hopefully now you've got a basic understanding and how it all works with the Forex and trading, and the reasons why you should get an accountant, or at least speak to a tax advisor, and a very good one at that, to make sure that you know that you're heading in the right direction and that you're paying what you need to pay. I'm going to wrap this one up now because I don't even know how long this video is, and I'm pretty sure that if you're still with me, then you really are the cool cats and the people that are serious about your trading, but I imagine I lost quite a few people along the way. But I will always aim to bring content-rich, high-value videos, because I feel that that is what's lacking, especially in this industry on YouTube. People gloss over it or just say go get an accountant. They have absolutely no idea what's behind it. Now this video is easy, like I said, just scratching the surface. You could do hours and hours on tax alone, but I hope that I have brought you some value and that you do now have a bit of a foundation and you know what you could talk about if you do go and try and speak to an accountant themselves. Now, if you are enjoying the content, please just hit that like button, subscribe to the channel if you haven't already, click on the alert so you make sure that you're alerted to my next video as soon as it comes out. I know it seems insignificant, it's only a small thing for you, but it does make a huge difference for me and the channel for me to keep continuing making this content. And as ever, if you've got any questions, post them in the comment section below. Head across to my Instagram @MattTomillion, and I'm always going through my DMs each week, so hopefully I will get back to you through that period. So reach out, follow me, do whatever you like. But if I don't speak to you before, have a great week and I'll catch you on the next one. Take it easy.